This video will help you understand some of the major highlights with Secure Act 2.0, specifically for those prepping for retirement. If you don't know who I am, my name is Chris Dime. I'm a certified financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. In my last video, we touched on some of the major highlights with Secure Act 2.0, and in this video, we'll touch on a few more highlights from Secure Act 2.0. As a quick refresher, this is that 4,000 plus page omnibus spending package that authorized like 1.7 trillion in new spending. That being said, it does have some awesome improvements for folks relative to their savings and investing. So let's jump into that. In my last video, we touched on some of the changes to RMDs, catch-up contributions, and then Roth accounts. In this video, we're going to touch on a lot more. We'll touch on employer plans, 10% penalty exclusions for pre-59.5 distributions. We'll touch on IRA violations. We'll touch on ABLE accounts, QCDs, and QLACs. So let's jump in. A really great improvement coming out of this Secure Act 2.0 is going to be the establishment of essentially a proverbial retirement plan lost and found. I don't know the specifics on how it's going to work, but the way that it seems to be marketed is that there's going to be some form of national database where you can log in with your social security number, etc., and find old retirement accounts that you may have forgotten about. This is going to be really helpful for folks trying to get their finances organized, whether they're in their 20s, 30s, 40s, or 50s, and they're trying to look at where all their retirement packages are at. Another update is starting in 2025, newly established plans in 2025 are going to have to automatically enroll their employees somewhere in the ballpark of 3 to 10% of their compensation automatically. And then that automatic contribution has to increase by 1% every year. I do believe you'll be able to opt out of this if you want to, but the jury is out for the most part on these retirement plans that if the employer automatically enrolls people at a certain level of contribution, they're far more likely to save money than if the employee has to opt in manually. Another cool update starting in 2024 is that employers are going to be able to match student loan contributions. So for example, if you're an employee that has student loans you're making payments on, your employer is allowed to match what you're paying towards your student loans into your retirement package. I imagine the thought process there is something to the effect of, if you're paying down student loans, you're probably not saving for retirement, but that doesn't mean that if you're at a company that the employer shouldn't be able to help you with saving for your retirement. Another cool update is that employers are going to be able to incentivize people to participate in the 401k. Let's say they opted out and they want them to opt back in. Employers are allowed to incentivize people through what the IRS calls de minimis incentives, which just means small. And so these would be things like gift cards or pizza parties, things like that. It's not going to be company paid for trips to the Bahamas, etc. Another update relative to eligibility for 401ks. This pertains more towards part-time workers. Back in the day, employers were allowed to discriminate against allowing part-time workers into the 401k if they worked less than 1,000 hours in a 12-month period, or if they worked less than 500 hours over a consecutive 3-year period every single year. Those rules have now been updated whereby employers can't discriminate against employees who work 500 hours a year for 2 consecutive years or more. So essentially it just reduces the amount of discrimination employers can have against not allowing certain employees, part-time employees for the most part, to set up and save into a 401k. The last update with retirement plans is going to be the emergency withdrawal provision. So this is a new provision that essentially says every 3 years you're allowed to withdraw a $1,000 emergency withdrawal out of the 401k or 403b retirement plan. You'll have to pay it back, and then once you pay it back, you're allowed to take it out again at some point in the future in 3 years. But it does allow for a $1,000 no penalty withdrawal from your retirement plan. Segueing on exceptions to the 10% penalty rule, further exceptions to withdrawing money out of your retirement plan before the age of 59.5. And as you may or may not know, age 59.5 is the minimum age you need to achieve, whereby any distributions before 59.5 from your retirement plan, whether it's Roth or pre-tax, you'd have to suffer an additional 10% penalty on money you take out of that plan. And so there's always been some exceptions to taking money out of your plan and getting exempted from that 10% penalty. Now you'd still owe federal income taxes and state income taxes on any pre-tax distributions you take out of a 401k, but you would be allowed an exemption to the 10% additional penalty that's generally applied for the following reasons. The age 50 rule, that still applies for public safety employees. So if you are age 50 and you achieve age 50 and beyond while working as a public safety employee, you're able to still take out money out of your retirement plan before 59.5 and not pay a 10% penalty. Also, the rule of 55 still applies, and that's the same thing. If you've achieved age 55 or beyond in certain 401k plans or 403b plans, you're allowed to take money out of your 401k before 59.5 without paying a 10% penalty. And the 72T, or substantially equal periodic payments, provision that also still applies, whereby before the age of 59 and a half, you can take money out of your retirement plans prematurely without paying a 10% penalty. But the updates from Secure Act 2.0 added a few more exceptions to the 10% penalty rule. These would be things like folks who are terminally ill, folks who are victims of domestic abuse, and then lastly, some qualified long-term care expenses. So let's touch on those. Relative to terminally ill folks, in the insurance world, that's pretty much always been defined as a physician has certified that you're going to pass away in the next 24 months. With the provision for the Secure Act 2.0 relative to prematurely distributing money out of your retirement plan, that time frame has now been expanded to 7 years. Now, the regulation does say you'd have to pay back this money within 3 years, so something to be cognizant of. It's not like you can just take a distribution and you're off in the sunset. I have no idea if you'll need to repay this at death or how that would work. More to follow on that. The other new exception we talked about were folks victims of domestic abuse. The IRS says you're allowed to take out the lesser of either 10 grand or 50% of the account balance within 12 months of the, we'll call it qualifying event or the domestic abuse situation. Now again, that has to be repaid in 3 years, so it's not all sunshine and rainbows, but this does provide some flexibility for those who need cash quickly and are looking to adjust to a new life, maybe, furnish a new piece of property, whatever. The last exception that I think is noteworthy is the ability starting in 2026 to take money out of your retirement plan to pay for long-term care premiums. And the regulation there says, again, starting in 2026, folks are allowed to take out the lesser of 10% of their account balance or $2,500 a year to pay for long-term care insurance premiums. I am not tracking that you'd need to pay this money back to your retirement plan, but that might be something to confirm if you're looking to do this. I'm sure we'll have more information by 2026. Okay, so moving on to retirement plan violations. So these are when somebody over contributes to a retirement plan. As we talked about in our previous video, there are certain limits that you're allowed to put into retirement plans. And if you violate those, the IRS is going to penalize you. So with the Secure Act 2.0, the rules haven't changed that any sort of excess contributions have to be removed, as well as what's called the net income attributable, which think of that as just the gain in your account as a result of that excess contribution. Those still have to be removed by October 15th in the year following the year you over contributed, and the 6% tax penalty on that over contribution still adds every single year together. What the Secure Act 2.0 updates is rather than the 6% IRS penalty for over contributing to an IRA, rather than starting that as of the day you file Form 5329, Form 5329 you'd only file if you knew you made an excess contribution. And so for most folks I know who make an excess contribution, they're unaware they made an excess contribution, so they don't file Form 5329. And so it added a whole host of confusion for folks trying to figure out what their penalties were, and then just ultimately getting a nastygram from the IRS, 3 years from when they made that over contribution, and now they owe a whole host of penalty taxes. Instead, what Secure Act 2.0 updates is that clock for the 6% penalty starts with filing Form 1040, which for the most part everybody files. This way, it's much easier to track down how much you actually owe in penalty taxes if you make an excess contribution to an IRA. Best practices, of course, are to work with some professionals and/or be aware of those over contribution penalties. And again, you have to take out the excess contribution plus net income attributable. The statute of limitations on an over contribution is 6 years, which is actually double what it is for missing a required minimum distribution when you're age 72 and beyond. Next update from Secure Act is good things is for ABLE accounts. So for those of you with loved ones with disabilities, or if yourself is someone with a disability and you suffered a disability before the age of 26, you might have been exposed to what are called ABLE accounts. ABLE accounts are essentially specialized investment accounts that you're allowed to contribute to. Money grows tax-free, and you can use that money tax-free if you spend it on qualified disability expenses. Now, back in the day, the qualification to set up and fund an ABLE account was you had to have suffered your disabling event before the age of 26. That age limit has been pushed all the way to age 46 now. I don't know why there's an age limit at all, but nonetheless, there is an age limit. And so now if you suffered your disability before the age of 46, you're allowed to open and fund an ABLE account. And the reason ABLE accounts are attractive for folks with disabilities is because if you have more than $2,000 to your name in assets, you generally won't qualify for Supplemental Security Income, or SSI. This could be a large part of somebody's income when they have a disability. And so rather than jeopardize them for that, you'd have to have the person have no assets. That's a pretty tough financial situation, is to have no assets and only income, and hopefully nothing breaks along that process. you could set up an ABLE account. There's a limit on how much you're allowed to put into an ABLE account each year, but theoretically you could have $30 billion in an ABLE account and it wouldn't jeopardize you from SSI. For 2023, the maximum contribution to an ABLE account is $16,000. And then thanks to the Tax Cuts Jobs Act that came out in 2017, if you are somebody with a disability, you have an ABLE account and you've made your contribution, yet you're working, you're allowed to actually put in more than the $16,000 limit. You're allowed to put in $16,000 plus either the annual poverty limit, which for 2022 was around $13,600, or the annual income you make from your job. You're allowed to add the lesser of those two to the $16,000 limit, and that's your actual annual limit to contribute to these ABLE accounts. So pretty much all good things for folks with disabilities who have ABLE accounts. Next up, QCDs, or qualified charitable distributions. These are distributions somebody might take out of their retirement account when they're past the age of 70 and a half, where if they were being forced to take out money from required minimum distributions and they didn't need the money and they were charitably inclined, they might choose to just donate to that charitable organization directly from their IRA rather than take that required minimum distribution, pay federal and state income taxes on it, and then try to itemize that deduction somewhere else on their tax return for donating to charity. If they donate it directly from the IRA, they avoid ever paying income taxes on that, which is a more efficient way to donate to charity than taking income, paying taxes, and then donating. Now, the age limit to be able to do a qualified charitable distribution is still age 70 and a half or beyond, but the maximum you're allowed to use for a QCD, which used to be 100 grand for the past 15 years, will now start to be indexed for inflation starting in 2024. So for now, it's still 100 grand, but in 2024, 2025, it should be starting to accumulate more. One cool nugget for qualified charitable distributions that came on the back of the Secure Act 2.0 is the ability to make what's called a split interest entity contribution. So rather than putting that full 100 grand QCD or less to a charity, you're allowed to split that contribution in half and use 50 grand of that to fund a CRAT, a CRUT, or a charitable gift annuity. Today's not the day where we're going to dive into these different structures and how they're valuable for charitable contributions, but just know that you don't have to solely donate that entire qualified charitable distribution to the charity directly. You can use some of these charitable tools to make those contributions and split your interest. Now, you're only allowed to do that one time, and each spouse could theoretically do it, right? 50 grand from spouse one, 50 grand from spouse two, if they had their own IRAs, but know that this is an option. That being said, the contribution to the trust or the charitable gift annuity has to be done solely from that split interest entity. So for example, if you had a previously established CRAT or CRUT, you couldn't add to that existing CRAT or CRUT this 50 grand maximum. You'd have to set up a whole new CRAT or CRUT and make that $50,000 contribution. So when you factor in, legal costs to set up the trust, the time and energy that goes into administrating it, the fees you might pay to an advisor to manage the money inside the trust, it doesn't really add up as being that awesome of a strategy, and it might not really be even worth your time. Nonetheless, it's an option that's out there. Okay, so last update from the Secure Act 2.0 that I think is noteworthy is the updates to QLACs, which technically are qualified longevity annuity contracts. These are deferred annuities that people will take portions of their IRA and put into when otherwise that IRA would start to get hit with required minimum distributions. So essentially, I think of this as like an annuity you can defer your required minimum distributions into until the age of 85. It's still an annuity, so for all the pros and cons that come with annuities and the guaranteed lifetime income, but the illiquidity that comes with all that kind of stuff, just be aware if you do a qualified longevity annuity contract, all that still applies. The real value of this is being able to defer what otherwise would be required minimum distributions you don't need. Previously, the limit on how much you were allowed to invest into a qualified longevity annuity contract was 25% of all your IRA balances or 135 grand, whichever's less. That 25% limit has been eradicated, and now the limit is 200 grand. So speak with your advisor as to the efficacy of using a QLAC as you get on in years. It might be something helpful to defer RMDs that otherwise you don't need. Okay, so calls to action. I'd say number one, if you or a loved one is somebody that has suffered a disability, please make time to be aware of how ABLE accounts can add value to their situation. If they don't have an ABLE account set up and their disabling event happened before the age of 46, it's absolutely something to factor into your financial plan, something to consider. Second call to action, if you are charitably inclined either now or you think you will be in the future, start thinking through qualified charitable distributions as something you could do with, for example, inherited IRAs once you hit the age of 70 and a half. A lot of times my clients with inherited IRAs from a loved one or whatever don't have a need for the required minimum distribution for their retirement plan because they're well planned themselves, and maybe they're charitably inclined and they want to use that forced required minimum distribution as a qualified charitable distribution. As well as folks that are in retirement right now and they're approaching their required minimum distribution date, which in my last video we touched on some updates to that, and they don't have a need for their required minimum distribution. Maybe they're not charitably inclined enough to want to donate it immediately. So instead, they might look at rolling up some of that into a qualified longevity annuity contract. So to recap, overall, a lot of great things from Secure Act 2.0. A few things I contend with, but nonetheless, if you have further questions, drop them in the chat below, send me an email, we'll get you squared away. Hope you have an awesome rest of your week. Hope it's helpful. Talk to you soon. Bye.